The earlier themes of high-performance culture, a winning mindset, and strengthening of the core are now an integral part of Axis Bank's DNA. We'll now discuss each one of these areas. Becoming a resilient all-weather franchise. I will talk about deposits first. Over the last couple of years, we have, in deliberate, planned steps, shifted the quality and strength of our deposit franchise in a marked manner. We have shared the trend on growth of granular deposits, reduction in LCR outflow rates, premiumization to Burgundy and Burgundy Private platforms, and embedding of Siddhi, our employee super app, and Sparsh, our customer experience transformation program, into the DNA of the branches. These initiatives have improved the health of our franchise significantly, and the impact of this was seen progressively every quarter in financial year 24 in our deposits market performance. We are carrying this momentum into financial year 25. I'll now take you through performance highlights of Q4. We continue to deliver higher growth in LCR, accretive, retail and small business deposits that stood at 18% year-on-year, 500 basis points higher than our overall deposits growth. We have improved our LCR outflow rates by 500 basis points in the last 2 years, which is among the best in the sector today. CASA deposits grew 8% quarter-on-quarter, and our CASA ratio as percentage of average assets for Q4 financial 24 stood at 32%, which is among the best in the sector today. We have further improved the growth trajectory of retail term deposits with 17% year-on-year growth that stood at 13-quarter high. On the corporate salary side, we have redesigned our corporate salary product proposition under Suvidha to win employer mindshare and get higher employee wallet share. Further access to 1,600 Suvidha corporate labels from the Citi acquisition with pan-India coverage as compared to a few cities earlier is also aiding the corporate savings account growth. Our premiumization strategy has performed well with Burgundy OEMs growing at a CAGR of 32% in 5 years. Burgundy Private launched 4 years back, now includes 35 of the Forbes 100 richest Indians as its clients and manages well for over 10,650 families across 27 cities pan-country. On the wholesale segment, Project Neo is helping to drive higher transaction banking flows, leading to better current account balances. Our NEFT market share in terms of value has increased to 12% in Q4 financial 24 as compared to 9% in Q4 financial 23. This was possible due to large CMS wins in the fintech payment aggregation space. Our deposit mobilization strategy has been led by 2 large transformation initiatives, Siddhi, a super app for our employees, and Project Triumph, leveraging the various business segments within retail, Bharat and SME, continuing to progress well. We have empowered 80% of the on-roll employees with Siddhi that now supports 24 product and service journeys, along with 21 types of nudges and notifications for them to have deeper and more meaningful customer engagement. The improvement in branch productivity is reflected in 49% increase in LCR accretive deposits per branch in the last 5 years. We have seen all-round growth across businesses, and we have now market-leading growth in our focus segments. Refer to slide 8 of the investor presentation. Our higher-yielding focus segments, including SME, mid-corporate, SBB, which is small business banking, rural, personal loan, credit cards together, have grown at a CAGR of 25% in the last 4 years and now constitute 43% of the total advances, up by 1,210 basis points during this period. We will continue to focus on driving growth across our business segments while following capital-efficient write-off model. Refer to the slides 10 and 11. We have delivered growth and profitability without compromising on the risk, which is reflected in our RWA to total assets trend that have seen improvement as compared to the past, bearing periods of risk weight changes. The fee profile is among the best in the industry today, with granular fee comprising 93% of overall fee, up 600 basis points since March 19. On the merchant acquisition business, we have moved from number 2 to leadership position during the year, with terminal market share of 20% as of March 24. As far as strengthening the core is concerned, while we strengthen the balance sheet and capital position significantly, we have also been consistently building and investing in the entire technology backbone, data analytics, digital and tech teams. We have early leadership in microservices-based cloud adoption and are the first Indian bank to be ISO certified for its AWS and Azure cloud security. As part of commitment to open API ecosystem, we now offer wide stack of 410 plus APIs on the developer portal. Our investment in emerging tech is demonstrated through creation of 3,500 plus RPA bots and leveraging Microsoft GenAI use cases focused on conversational banking, automation, and AI service enablement. This year, we have also embarked on further strengthening our enterprise class systems of engagement with Salesforce journey that will further aid in making the systems more scalable and future ready. Our second pillar was creating multiplicative forces to build competitive advantage. Our readiness to partner with innovative fintech ventures has created a dynamic ecosystem that fosters innovation, enhances the customer experience, and sets new industry standards globally. We believe we are well placed to play all the socio-economic mega trends of the next decade and beyond. The multiplicative forces that we have built through a unification of One Axis, 100+ partnerships, and new age tech platforms give us the right to win. Slide 13 to 16 provide more details. Citibank consumer business integration remains on track. Deposits are largely stable, while there has been growth in retail assets and wealth management led by improvement in cross-sell metrics. We are now live with the first change in the migration journey for the transitioning customer base with IFC migration, enabling payments to Citibank accounts using Axis Bank IFC. This has been made live in March 24. We have successfully completed the migration of CVCE loans portfolio in March 24, and the customers have now fully migrated from Citi systems onto the Axis systems. The integration of the other assets and liabilities remains on track. Third pillar, building for the future. We have tried to be ahead of the curve towards building a bank for the future with deep investments of management time and resources in our chosen areas of distinctiveness, namely digital, Bharat banking, and customer obsession. We have started seeing early results of these investments, even as we remain focused to further drive scalability and productivity across the organization. Digital banking performance continues to remain strong. Open by Axis balance sheet continues to deliver strong growth with 33% in deposits and 74% increase in loans. Open by Axis continues to be the highest rated mobile banking app on the Google Play Store with a 4.8 rating. On the iOS App Store too, the rating has increased to 4.8 this quarter. Keeping with the thoughts of Dil Se Open, Open by Axis is now available in multilingual mode. 4 languages are now supported by both our mobile app and our internet banking portal. In financial 25, the bank intends to take further steps to increase accessibility of its digital channels. Neo for Business. Our MSME proposition now has 60,000 customers onboarded over the last 2 quarters. Neo for Corporates is being scaled up with customer migration currently underway. The migration here will continue to scale up till Q3 while we continue to launch additional capabilities. With full rollout of Neo, Axis remains on track to become the operational bank of choice for our wholesale banking clients. Our bank-wide programs to build distinctiveness continue. Our bet on Bharat is going from strength to strength. The financial 24 disbursements sold by Bharat Banking were up 30% year-on-year, rural advances up 30% year-on-year, and deposits from Bharat branches up 12%, thereby aiding the PSL and profitability metrics. In rural advances, the balance sheet added in the last 24 months is 1.75 times the size of the balance sheet added in the previous 4 years, which is March 18 to March 22. We have expanded our multi-product distribution architecture to 2,482 branches, complemented by 64,550 CSC VLE network across 683 districts and 80+ partners across the industry. It has also contributed significantly to the bank's overall PSL achievement at 46.37% for financial year 24. Sparsh, our customer obsession program, is helping improve relationship and transactional intensity with our customers. Our Gen AI conversational chatbot is empowering frontline employees to efficiently address queries on core products. In closing, the Indian economy continues to remain a bright spot with its favorable macros backed by strong and stable domestic policy environment, which bodes well for the banking sector. In the near term, the geopolitical tensions continue to pose risk to the food and commodity prices. We retain our stance of policy rates staying higher for longer and foresee the system credit growth to converge towards deposit growth of around 13% for the fiscal. We will continue to be differentiated and distinctive in our journey to improve our service and performance levels for all our stakeholders. We remain focused towards building an all-weather institution that will stand the test of time. I will now request Puneet to take over.
Thank you, Amitabh. Good evening and thank you everyone for joining us. We continue to make good progress towards building a stronger, consistent and sustainable franchise. The salient features of the financial performance for FY24 and Q4FY24 across our operating performance, capital and liquidity position, growth across our deposit and loan books, asset quality, restructuring and provisioning is as follows. In Q4 and FY24, our operating performance was strong across NIMs, fee and credit cost lines. We discussed key metrics for FY24 on a reported basis as follows. FY24 net interest margin was 4.07%, up 5 basis points YOY. in line with our consistent commentary that NIM should be compared on a 12-month basis. Net interest income stands at 49,894 crores, a growth of 16% YOY. Fee income stands at 20,257 crores, 28% YOY growth. Granular fees is 93% of total fees. Operating profit stands at 37,123 crores, 16% YOY growth. Cost to income stands at 48.68%, improving 18.03% YOY on a reported basis. Credit cost at 0.37%, lower 3 basis points YOY. PAT stands at 24,861 crores, increasing 160% YOY. GNPA 1.43%, declining 59 basis points YOY. Net NPA at 0.31%, declining 8 basis points YOY. Standard asset coverage ratio of 1.26%. All provisions by GNPA ratio at 159%, improving 13.73% on a YOY basis. Consolidated ROA at 1.84, improving 99 basis points YOY. Consolidated ROE at 19.29%, improving 10.03% on a YOY basis. I move to numbers that are now reported for Q4 FY24 on a reported basis. Consolidated ROA at 2.07%, consolidated ROE at 20.87%. Subsidiaries contributed 7 basis points of consolidated annualized ROA and 52 basis points of consolidated annualized ROE. Bank's CET1 including profit stands at 13.74%, improving 3 basis points quarter on quarter. Organic CET1 accretion for FY24 including profits was 44 basis points. Change in regulation adversely impacted CET1 by 72 basis points. Prudent COVID provision of 5,012 crores has not been utilized or written back to P&L. It has been reclassified as other provisions to be largely utilized upon ECL transition. This provision has not been reckoned for capital computation and translates to a capital cushion of 41 basis points over reported capital adequacy ratio. The reported CET1 at 31st March 2024 of 13.74% is after fully incorporating the impact of 1,612 crore investment in Max Life funded in April 2024 and the proposed dividend of rupees 1 per share or a 50% dividend rate. The bank assesses its capital position on two pillars, growth and protection. We reiterate that we do not need equity capital for either pillar. The bank is proposing to take a purely enabling resolution for equity capital and borrowings from its shareholders in the normal course. Net interest margin for Q4 FY24 is 4.06%, improving 5 basis points on a sequential quarter basis. Yields on interest earning assets improved by 11 basis points on a sequential quarter basis. This increase sufficiently addressed the increase in cost of funds of 8 basis points Q on Q. NII at 13,089 crores, growing 11% YOY and 4% Q on Q. Fee at 5,637 crores, growing 23% YOY and 9% Q on Q. The fee for the quarter is 93% planning. Operating profit at 10,536 crores, grew 15% YOY and 15% Q on Q. Cost to income for the quarter was 46.94%, declined 252 basis points on a sequential quarter basis. Net credit cost at 0.32%, increased 4 basis points Q on Q and 10 basis points YOY, mainly driven by lower recoveries and upgrades. PAT at 7,130 crores, increased 17% Q on Q. YOY PAT is not comparable due to reported loss attributable to exceptional items debited to P&L in Q4 FY23 relating to the Citibank acquisition transaction. GNPA at 1.43 declined 15 basis points QOQ. NNPA at 0.31 declined 5 basis points QOQ. The bank's own assessment is that we are PSL compliant at a headline level and at each subsegment in FY24. Our progress on structural NIM drivers continues with improvements across all variables on a YOY basis. Balance sheet mix, loans and investments comprise 88% of total assets at March 24, improving 168 basis points YOY. INR denominated loans comprise 96.2% of total advances, improving 130 basis points YOY. Retail and CBD advances comprise 71% of total advances, improving 303 basis points YOY. Low-yielding RIDF bonds declined 9,007 crores YOY. RIDF comprises 1.5% of total assets at March 24, compared to 2.3% at March 23. Quality of liabilities measured by outflow rates improved by 500 basis points over the last 2 years. Our month-end CASA balance, CASA ratio is 43%, continues to be amongst the highest in the large private sector universe, improved 85 basis points on a Q1Q basis. Our fee performance was strong, reflected in a fee growth of 9% Q1Q. Total retail fees grew 33% YOY, 12% Q1Q. Our third-party products fee grew 59% YOY, 44% Q1Q. Retail cards and payments grew 39% YOY. Retail assets, excluding cards and payments, grew 20% YOY. Trading profit and other income of 1,128 crores was higher by 909 crores and grew 443 crores sequentially, mainly on account of better DCM and trading performance and reversal of MTM booked in previous quarters. Operating expenses for the quarter stood at 9,319 crores, growing 27% YOY, 4% sequentially. It's pertinent to note that there is only 1 month Citi BAU expenses in Q4FY23. We opened 125 new branches in the quarter and 475 new branches through the year, in line with what we guided at the start of the year. Integration expenses contribute 3% of the YOY growth in percentage terms and 11% of the YOY growth in rupee terms. The balance YOY growth in rupee crore expenses, other than above, can be attributed to a negative 2% linked to volumes, 51% growth on technology and growth-related investments, and the balance 40% for BAU costs. Technology and digital spend grew 32% YOY and constituted 9.3% of total operating expenses. Our staff costs increased by 35% YOY. We've added 12,735 people for the same period last year, mainly to our growth businesses and our technology team. The quarter-on-quarter increase in operating expenses is largely attributable to staff costs, technology and growth-related investments. We added 4,983 people in the quarter. Provisions and contingencies for the quarter were 1,185 crores, higher 15% Q1Q, largely attributable to a higher coverage of 1% on a full book basis. The bank continues to prudently carry 100% provision on its AIF investments. The cumulative non-NPA provisions at 31st March 2024 is 12,134 crores, 12,134 crores, comprising provisions for potential expected credit loss of 5,012 crores, restructuring provision of 535 crores, standard asset provision higher than regulatory rates of 2,029 crores, weak and other asset provision of 4,558 crores. Growth across our liability and loan franchise. Please refer slides 36 to 38 for details around the quality of our liabilities franchise and slides on our loan franchise. Total deposits on a QAB basis grew 16% YOY, 5% QOQ. Our QAB CASA ratio was 40.74%. The outflow rates on our deposits improved by 100 basis points YOY, indicating improvement in the quality and lendability of our retail and non-retail deposits. In order to ensure like-for-like comparison of deposits, growth with peer banks, the bank will report total deposit growth as part of its disclosures in FY25, along with LCR quality of deposit metric. The bank sold IBPCs in the current quarter aggregating to 4,564 crores. Grossed up for IBPC sale, the Q1Q loan growth is 4% and the YOY loan growth is 15%. Our loan book is well balanced, with retail advances constituting 60% overall advances, corporate loans at 29%, and our CBD book at 11%. 70% of our loans are floating, 47% of our fixed rate book matures in the next 12 months. Breakup of the floating rate loan book by benchmark type and MCLR repricing frequencies set out on slide 28 of our investor presentation. Retail advances for us grew at 20% YOY, 7% sequentially. 72% of the book is secure. Q4 FY24 retail disbursements, including Bharat Bank, grew 8% Q-on-Q. Unsecured disbursements were 25% of retail disbursements for the quarter as compared to 24% in the previous quarter. Disbursement growth in LAP was 23% YOY and 9% Q-on-Q. Retail agri was 18% YOY, 25% Q-on-Q. PL was 49% YOY, 7% Q-on-Q. Wholesale banking coverage. Details of rating composition, incremental sanction quality is set out on slide 55. Gross up for IBPC sale, the domestic asset loan book grew 10% YOY and was flat Q-on-Q. Offshore wholesale advances are largely trade finance related and primarily driven by our city branch. 97% of the overseas standard corporate loan book in India is India linked, and 93% is EMI rated and above. The commercial banking book grew 17% YOY, 5% Q-on-Q. The quality of the CBG franchise we are building is strong, and relationship-led approach is reflected through CBG new to bank book grew 14% YOY. 83% of our CBG loan book is PSL compliant. Coming to the performance of our subsidiaries, detailed performance of our subsidiaries set out on slide 86 to 93 of the investor presentation. In FY24, the domestic subsidiaries reported a net profit of 1,591 crores, growing 22% YOY. The return on investment of domestic subsidiaries was 54%. Axis Finance overall assets under finance grew 38% YOY. Retail book constitutes 45% of total loans. FY24 PAT grew 28% YOY to 610 crores, and Axis Finance has a healthy capital adequacy ratio of 19.24%. Strong asset quality with a net NPA of 0.28% and negligible restructuring. Axis AMC overall quarterly AUM grew 14% YOY to 2,74,265 crores. FY24 PAT stood at 114 crores. Axis Securities broking revenues for FY24 grew 58% YOY to 1,143 crores, and PAT grew 48% YOY to 301 crores. Moving to asset quality, provisioning and restructuring. Asset quality continues to improve with gross and net NPA in rupee terms and percentage terms declining sequentially and on a year-on-year basis. The slippage, GNPA, NNPA and PCR ratios for the bank and segmentally for retail, CBG, corporate are provided on slide 78 of our investor presentation. Gross slippages for the quarter were 3,471 crores, declining 7% Q-on-Q. Gross slippages segmentally were 3,110 crores in retail, 163 crores in CBG, and 198 crores in our WBCG businesses. Gross slippage ratio annualized stood at 1.48%, declining 28 basis points YOY and 14 basis points QOQ. For the quarter, 35% of our gross slippages are attributable to linked accounts of borrowers, which were standard when classified or have been upgraded in the same quarter. Net slippages for the quarter were 1,317 crores. Net slippages segmentally was 1,616 crores in retail, 51 crores in CBG, and negative 350 crores in the WBCG business. Recoveries from written off accounts for the quarter were 919 crores. Net slippages for the quarter adjusted for recoveries from written off pool was 398 crores, declining 17% Q1Q. Segmentally, retail was 1061 crores, CBG was negative 62 crores, and WBCG was negative 601 crores. To summarize, Axis Bank is progressing well to be a stronger, consistent, and sustainable franchise. Consolidated ROA and ROE for FY24 of 1.84 and 19.9% respectively are an outcome of disciplined execution. The bank has ample and sufficient liquidity visible in an average LCR ratio of 120%, which improved 171 basis points Q1Q. Deposit growth could be a key constraint to growth in advances in the short term. In the medium to long term, we believe our advances can grow for 300 to 400 basis points faster than industry. We are well placed in the current macro environment. We continue to closely monitor geopolitical, inflation, liquidity, cost of funds and its impact on our businesses. Opening remarks, and we'd be happy to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. An operator will take your name and announce your turn in the question queue. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is from the line of Chintan Joshi from Autonomous. Please go ahead.
Hi, thank you. I have two questions, one on NII and one on costs. On NII, if I can start with that, last quarter when we were discussing how NII develops, got a sense that there would be more pressure on the liability side and that NIMs would be a little lower than what you've reported, which is a good thing. But I just wanted to understand, was there anything that helped alleviate, any pressures or helped post better than expected NII performance this quarter? So therefore, what was the underlying improvement since the third quarter commentary, and how should we think about the future? On costs, just a broad question, help us on how we should think about cost to asset evolving in FY25.
Chintan, thank you for your question. On net interest margins, I can simply answer the question by saying there are no one-offs in our net interest margin or net interest income for the current quarter. The improvement in net interest income and net interest margins is on account of disciplined execution. We've had a book mix shift and we've had pricing improvements across the portfolio that have driven this outcome. To your second question on cost to assets and outlook, we do not offer guidance or outlook on the cost to assets metric. We have consistently maintained that as long as we can deliver the 18% return in and around the 18% return on equity on a consolidated basis, we'd like to continue to invest in the franchise. That's where I would leave the response. We do not offer sequential, annual, or forward-looking guidance on cost to assets. Thank you.
Thanks, Puneet. On margins,
sorry to interrupt you. Your voice is coming a little muffled.
Oh, okay. I'll speak louder. If just on the margins, if I can, sorry.
Can I add, Amitabh here?
Yes, hi.
As Chintan, all I just want to say is that, just adding to what Puneet said, while obviously we have been consistent about the fact that if you look at what's happening in the market, the trend line would be that the deposits are still getting repriced while the asset repricing has happened, but that does not mean that we have some levers at play in our hands. And I think what we've been just trying to do as an enterprise is to just use those levers and see how we can maintain margins and continue to try to improve them. So as and when opportunities arise, we will obviously try to grab them and try to ensure that we don't go south in terms of margins, but we maintain them or improve them. So I'm not trying to give you any guidance, but I'm just trying to say that the intent of the management team is to obviously continue to deliver, as I said in my opening remarks. So just want to leave that thought with you. Sorry, you were asking a question.
That's exactly what I was asking. So thank you so much.
Thank you. Next question is from the line of Mahrukh Adajania from Nuvama Wealth. Please go ahead.
Yeah, hello, hi, congratulations. My first question is on LDR. So would you have a broad framework in mind on, say, peak LDRs? Like, would you want the LDRs to stay at 90 or 89 or any such peak or, cap you have in mind on LDR?
So, Mahrukh, we have a clear strategy in mind on the LDR side, and not that something which we're guiding towards or talking to the market about, but there's a clear strategy. If you look at our LDR ratios, they have trended in a particular direction. Our hope is that we would like to maintain it within a zone and ensure that we understand and appreciate where the regulator is coming from, and at the same time have flexibility to grow at a certain rate going forward in the future. Obviously, none of it can happen without deposits coming at a certain growth rate. So broadly, that's how we're thinking about LDR.
But for the next few quarters, should we assume that deposit growth would outpace loan growth?
That will be giving a guidance, no, Amarat. So, yes, but I mean, I can't take away the fact that deposit growth will be an important determinant in driving credit growth. Without that, being able to showcase credit growth would be quite difficult. But that is something which we have been saying even before all the noise started in LDR. We have been talking about for quite some time that at some stage the deposit growth and the credit growth needs to converge. This gap cannot continue forever. And I think we've been saying that for quite some time.
Okay, Gaurav, my final question is on cost of funds. So obviously for most banks, there has been some quarter-end deposit mobilization. You, of course, transparently disclose what's MEB and what's QAB. But given that and given obviously intensive competition, can we assume that cost of funds have peaked? Because they look very resilient over the last 2 quarters for you. Assuming that there are no further policy rate changes?
Maruf, thank you for the question. We've previously stated that if the marginal cost of funds remains where it is today, given the current status of our book, we should finish back book repricing in Q2 of the current financial year.
Okay. Thanks a lot. Thank you.
Thank you. Next question is from the line of Rikin Shah from IIFL. Please go ahead. Rikin, may I request you to unmute your line and go ahead with your question, please? Due to no response, we move on to the next participant. The next question is from the line of Pranav from Bernstein. Please go ahead.
So thank you. I have 2 questions. First is on the deposits. So there's been a very clear improvement in the quality of deposits.
To interrupt you. May I request you to speak a little louder?
Is it better now?
Yeah, thank you.
Okay. There's been a phenomenal improvement in the quality of deposits over the last few years. Is it fair to say that we have reached a certain level of or the target state in terms of the quality of deposits, and therefore now the growth could once again start being much higher than the system growth, like what the long-term guidance has been? And the second question is more on the third-party fees. There's been a punchy growth quarter on quarter. Is that one-off or is it a new level of third-party fees that we should expect going forward?
Yeah, hi Pranav, this is Subrat. So, the journey to continue to improve the quality of the deposit franchise is ongoing. I mean, we've kind of highlighted over the last 3 years how the trends have moved in some of the key metrics that we track for deposit quality. We still don't think we have, reached anywhere near a plateau in terms of improving these metrics. There is also another level of productivity that we are continuing to work on. We have mentioned Triumph, a program that we are working on to improve deposit productivity across the board, as well as working on making sure that the bank becomes the primary bank for a lot of our, deposit account holders. So I think the progress is satisfying so far. But like I said, we still believe we have levers left, which we'll continue to work on over the next 4 quarters.
If I can just add to what Subrat mentioned, as I think about savings in 3 buckets: retail, corporate, and government. Retail, as Subrat mentioned, there is work that's going on in terms of improving productivity, improving distribution, improving our and continuing to grow on our digital capabilities. We spoke, Amitabh in his opening comments spoke about Suvidha, which is a new improved version of our corporate salary program, including the 1,600 corporates that have come to us thanks to the Citi acquisition. On the corporate side, we are working on multiple fronts, salary accounts, given the fact that corporate India is cash surplus at this point, in seeking out franchise level deposits, and finally driving flows through Neo. And finally, the government side of the business has increasingly become a lot more solution oriented, which actually works, which actually plays to our strengths. And we are now able to chase across multiple programs, both at the central and state government. We're able to chase money from the Consolidated Fund of India all the way down to the beneficiaries. And that also is a partnership that is working well between our government business on one side and Bharat Banking and the distribution that is getting built on the other side.
Thank you. That's very helpful.
Thank you. Next question is from the line of Kunal Shah from Citi. Please go ahead.
Yeah. So once again, to touch upon margins, so as you indicated, there is not much of a interest reversal benefit, even though this time we have combined both interest reversals as well as spreads to go together in 5 basis points. But when we look at it in terms of the incremental spreads, so given that cost of deposits have also gone up by 8 odd basis points, are we seeing the entire mix shift and the overall, when we look at it, the pass on in terms of the lending rates, leading to this kind of improvement in spreads as well? And does it give the flexibility to increase the deposit rates? I think in less than 2 crores, we are still below many of our peers. And to just shore up the retail deposit, should we do that in terms of the deposit rate hike?
Kunal, thank you for the question. Just would like to clarify, interest reversals on GNPAs when booked and interest reversals on GNPAs when upgraded on a realization basis, we treat as normal course of business. So for us, exceptions would be something like an income tax refund or some one-time income that has come through on account of a large recovery, etc., is what we would call as one-time. So my response that we do not have a one-time interest income in the current quarter should be read in that context. To your second question,
but sorry, anything reversal within this? Any interest reversal within this, which is in the normal course? Because we are seeing a good recoveries as well of 2,100 odd crores.
So, Kunal, we have recoveries and upgrades every quarter. So like I said, it is in the normal course. We have no exceptional item, and I'll reiterate that for you. We have no exceptional item in the net interest income line for the current quarter. To your question on our ability to pass on increase in cost of funds, we had an 8 basis points increase in cost of funds on a sequential quarter basis. Our yields on interest earning assets moved up by 11 basis points. So that should address your question on incremental spreads. On a full year basis, we had a roughly 95 to 97 basis points increase in cost of funds, and we had a 90 to 97 basis points increase in yield on interest earning assets on a full year basis. So the quarter on an exit basis is better than the full year, but even on a full year basis, we've been able to pass on our cost of deposits.
Sure. And secondly, with respect to the composition of the retail book, so that's also more towards the high yielding. In fact, when we look at the mortgage, that has grown merely at 5% compared to 20% growth in retail assets. So would that strategy continue, and what would be our plan with respect to the home loans? Because most of the other segments we are seeing like PL, the overall rural banking as well as SBB and all growing at a rapid pace compared to that of the home loans. So is it more like the trying to manage the margins and that's the reason home loan is growing, or it's maybe the competitive environment?
So I think we have shared our strategy on how do we decide in a constrained environment on which assets we need to grow, we use RAROC, risk-adjusted return on capital, as the measure to drive that decision. And if you look at RAROC on mortgage business, if mortgage is the only thing I do with a customer, it tends to be much lower than a lot of other asset classes. So I think what you see on ground or what you see in our numbers is a reflection of that strategy. And if we continue to remain in a deposit-constrained environment, that strategy would ensure or would continue to force us to ensure that we grow some of the lower RAROC asset classes at a lower rate than some of the others. So I think we have been very consistent about how we go about, our loan growth across various asset classes, and depending on what the environment is, we will continue to drive our strategy accordingly.
Sure.
Just to add to what Amitabh said, I think as a system we have the ability to grow asset classes faster, but all depends how the borrowing environment is, and at the right time we can grow each of the asset business. Our overall asset growth this quarter is about 7%, which is a fairly strong growth. And if the economics is right, deposit situation or the liquidity is fine, you will see all asset classes going.
Okay. Yeah, got it. Thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi team. Congrats on the quarter. Some of my questions have been answered, but I have a few clarifications. Firstly, did we mention at the end that we'll now grow 300 to 400 bits faster than the industry?
Kiran, thank you for the question. We mentioned that we'll grow 300 to 400 basis points faster than the industry over the medium to long term. Medium to long term being defined as 3 to 5 years. 300 to 400 basis points.
Yeah, so that is, our stance has changed because the industry is growing faster or because you want to reduce LDR, or over the medium to long term, I don't think LDR should be an issue. So just wanted to understand why the change in stance. Hello, am I audible?
Can you hear us?
Should I repeat? No, Piran, we heard your question. Thank you for your second question. I think we haven't changed our stance. What we are saying is in two parts. In the short term, deposits growth will drive advances growth. Our expectation is deposits will grow 13% next year, and advances, therefore being driven by deposits growth, should be in the same range for the industry. That's the first comment we made on the call. And that's an industry level comment, not a bank level comment. The specific bank level comment we've made on this call is to say we have the confidence in the franchise to grow 300 to 400 basis points faster than industry in the medium to long term. I hope that sets context right to both responses. One comments and one in mind.
Okay, perfect. No, that clarifies it. Secondly, and I know you can't maybe share too much of details, but if you can just give some sort of comfort on in the recent past, has RBI, in discussions with you, highlighted any sort of, tech deficiencies, KYC issue, customer onboarding, etc., because in the last 3 months we've seen RBI being pretty active, and we saw something today also. So just wanted to get some sort of comfort on this front, if you don't mind.
Yeah, sure. This is Subrat. Listen, we can't, disclose what, communication goes on between us and the regulator. However, if you remember, even during the analyst day that we had in November, we spent considerable amount of time talking about our tech architecture, the focus on resilience and availability, because those are the cornerstones of the strategy that we have put together within our technology landscape. What that means is in terms of making sure that we are partitioning some of our core banking systems, moving some parts of it to cloud to make sure that some of the high velocity, low value transactions are separately managed. We continue to build fairly industrial strength back-end infrastructure, update the end of life, end of support applications and operating systems. All of that is part of what we think are very integral, apart from all the cutting-edge work that we do on the digital side, to keep the shop running and running at a fairly resilient and predictable manner. So we continue to do that, and we'll continue to give you the update. A lot of questions in the past have been asked about the investment in tech that we do. A lot of it has gone into resilience and availability. So we'll continue to be on that path. Like I said, this is an area that can surprise you any day, so we are being very, very careful about this.
Got it. Okay. Thank you, Subrat. Just my last question on yield improvement. So one part is loan mix, but simply driven by pricing, how much further can yield improve?
Piran, thanks for the question. Honestly, pricing is market dynamics, very difficult to call out. I can give you an indirect response. The rate increase has not been fully passed on to customers. So it'll be a function of how our peer banks and market behaves on incremental price pass on our customers.
Okay, but how much has been the incremental amount? That's really my question. So the repo-linked book obviously has not changed. That's half of your book. But the fixed rate book, which is about 30%, what sort of rate hikes would we have taken in 4Q? I understand that only on the fresh disbursement, but still.
Understood. Since we don't put out the data on rate hikes on a quarterly disbursement basis, but I can give you a pointed answer to your question. Our yield on interest earning assets has moved up by 11 basis points in Q4 against an 8 basis points increase in cost of funds.
Okay. Thanks a lot for answering my questions, and all the best in the coming quarter.
Thank you. Next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi. Just two questions. One is there has been a slowdown in the credit card outstanding on a sequential basis, while the PL book has kind of done reasonably well. If you could just kind of qualitatively call upon as to what happened on these two products.
Yeah, thanks for the question. Can you hear me? This is Arjun here.
Yeah, I can.
Yes, sir.
Yeah, so this is actually what we've seen is that credit card spends have moved in line with their cyclical patterns, and we've also seen that the overall outstanding in the industry, the growth rate has tapered, but I wouldn't say they've slowed down. This is a reflection of two factors. We've been calling out for a long time that the revolve rates in the industry have been coming down, and as that happens, we see that people pay down more of their balances, and therefore the balances left outstanding at the end of any statement cycle come down. So that's one qualitative aspect. You'll also note that we have not slowed down on the pace of acquisition, and this is for the 7th quarter in succession we've done. In fact, this quarter we did 1.28 million cards. So we've continued to grow our cards acquisition, and we're doing that in a thought-through, calibrated fashion. We will be building out the balances, the combination of spending and lending as we have done in the past to build those back. But we don't see this as any kind of protracted slowdown or an indication of a slowdown in the industry at a gross level.
Ajit, just to clarify, qualitatively, some comments on the asset quality side as well.
Sorry, some comments on the asset quality of cards, is it?
Cards and the secured loans.
So they remain within our guardrails, and as I mentioned, our growth is in a calibrated and thought-through fashion, which one aspect of that calibration includes assessment of how we see early risks moving, and we're fairly dynamic in the way we change our policies in response to what we see. Both on cards and on personal loans, we continue to do that. We've not seen anything worrisome on the asset quality. Having said which, we continue to keep a close eye on it because we obviously understand the nature of these two portfolios to be what they are. So we're not stepping back on anything, but we're keeping a close eye and will continue to do so. So far.
Thanks for this. Puneet, Amitabh, on this notification that you have done with respect to raising capital, it doesn't look like the next year's loan growth seems to be very high. Aspirationally, the number on ROE still looks fairly healthy. If you could just kind of comment what's the rationale around this possible capital?
Mahesh, thank you for the question. What we simply said is we assess our capital position on two pillars, growth and protection. We reiterate that we do not need capital for either pillar. These are purely enabling resolutions for the financial year.
Mahesh, do you have any follow-up question?
No, I am not.
Thank you. The next question is from the line of Aram Subramanian from Nomura. Please go ahead.
Yeah, hi. Thanks for taking my question. Most of my questions have been answered. Just one on deposit growth. So if you see this year, we closed at about 13%, which is in line with the sector, 13% YOY. And even last year, if we adjust for what we got from Citi, we grew about 10% YOY. So, of course, we've improved the quality of the franchise quite a bit, and the outflow rates have come down. But do we start becoming, a market share gaining entity from, say, next year onwards? And we are talking about sector growing at 13% deposit growth in FY25. What number would you have in mind for the bank? Yeah.
Yeah, hi, this is Manish. So, won't be able to give a guidance on the deposit growth rate for next year, but like Amitabh shared in his address, there are a number of things that we are doing to improve the quality and the market share gain that we are running for through number of structured programs that we are running across the franchise. We continue to hope that we will our growth rates will be in line with our current trends, and we will continue to invest in the growth of the franchise through distribution expansion, through the tech initiatives, for enablement of our sales force. So it's difficult to say a number whether we'll, how much market share we'll gain in the next few quarters.
Okay, fair enough. Thank you and all the best, and congrats on the great quarter.
Thank you. A request to all the participants, kindly use handsets while asking a question. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, sir. Just two questions. So one is, could you just comment on the net slippages, both in corporate and SME? They continue to be negative. So how long would you expect that situation to last? And the second is, just want to confirm on this borrowings number. I just want to get how much is the refinance. The number I'm getting basis your disclosures is about 1.1 trillion. I just want to confirm if that number will be about right, like the total refinance borrowings and the total borrowings. These are two questions. Thank you.
Thanks, Saurabh, for your question. On the refinance number, give me a couple of seconds to come back to you. Sorry, I missed your first question. If you would be kind enough to repeat that, please.
Yeah. So just on the refinance, is this considered like for an adjusted LDR calculation? Will this be because this would be backing certain assets? So is there like an adjusted LDR which you do for taking out refinance or no?
Requirement, Saurabh, to do an adjusted LDR, because at the end of the day, the LDR is a prescribed formula. So it is total loans by total deposits.
Okay.
If a loan is financed by refinancing, it will still sit in the numerator but will not be in the denominator if the denominator is not being classified as a deposit. I hope that clarifies. On the amount, I will come back to you on what the amount is.
Okay.
And the second question that you have...
On corporate and SME,
I think we've had, if you look at the performance that the bank has delivered, we've had negative slippages on the wholesale book Q4 last year, Q3 this year, and Q4 this year. So the wholesale book is actually on mend and quality has improved. But let's be honest, wholesale recovery is episodic. So will that consistently continue and repeat itself every quarter? Difficult to say. Our CBG book has behaved well. We did recognize a set of assets during the COVID period, and we're seeing recoveries come back from that class of assets. It's small, but likely to continue. We're not seeing a divergence there from a recovery performance standpoint. On the refinance number, I think you called out 1,10,000 crores. The exact number is about 1,14,000 crores. So you're ballpark.
Okay. All right. Thank you.
Thank you. The next question is from the line of Rikin Shah from India Infoline. Please go ahead.
Hi, thank you for the opportunity. Just one question. Puneet, if you could provide some color on the nature of trading gains in this quarter. And I also observed that in the investment breakup, the HTM proportion has gone down to HFT. So does that have to do with the new investment norms, and how should we think about the financial impact in the quarters to come by?
Rikin, thank you for the question. The new investment norms are applicable 1st April. So the 31st March balance sheet is prepared and reflected under the old norms. On trading gains, to your question, we have trading profit and other income of about 1,128 crores. And that grew by 743 crores sequentially. A large part of that gain has come through our debt capital market, our treasury trading performance, and MTM, a reasonable sized reversal of MTM losses booked in the last quarter.
Right. Puneet, just to clarify on this, while I'm aware that this norms kick in from 1st April, is the investment book positioning in anticipation of that? And if you could also help us think about what could be the potential implications on the financials in the coming quarters basis the new norm, that would be helpful.
So there is no positioning ahead of these norms. This is Neeraj Gambhir here. There's no positioning ahead of these norms. We basically are going to take the existing book and reclassify the existing book basis what works from a, the overall strategy perspective. To your question about how it will affect the overall, overall pattern of investments by the banks, I think it's too early to say. As you would know that the ability to move bonds from HTM to AFT at the start of the year has gone away. While we as a bank did not use it in the last several quarters, I think several other banks in the market did use that. So whether that will change the trading pattern of the banks, I think that remains to be seen.
Got it. Thank you very much.
Thank you. Next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Hi, good evening, gentlemen. One question on fee. So if I see our core fee or retail fee as a proportion of...
Jay, sorry, but your voice is not coming clear. Can you please speak through the handset?
Yes, hi. Good evening, everyone. So we wanted to understand on core fee to asset ratio, which has been improving and has improved quite substantially from 1.1% to 1.2 and now to 1.35. Of course, we have had some changes in the loan mix, but given now, as of now, I mean, how should one, think at this ratio? Could this be a part of your, ROA expansion if you were to see that?
Thank you for the question. We operate at fee to assets higher than equivalent private sector peer banks. Please do not estimate or expect further optimization on the fee to assets ratio on a go-forward basis.
Right. And lastly, just basis previous question on the new investment norms. I think all banks were supposed to redraw a balance sheet on 1st April. If you can share, does that mean an accretion to CET1 capital and maybe the rough quantum within that? And do you also have to sort of do such thing for your subsidiary also? Yeah. Thank you.
Thank you for the question. We have redrawn performance.
Sir, sorry to interrupt
the
you.
investment
Your
portfolio.
audio.
Sorry, my apologies. Am I clear now?
Yes.
Yeah. Thank you for that question. We have redrawn the balance sheet position as at 1st April. We are, however, unable to discuss its impact currently. We'll discuss that as part of our Q1 commentary when we report Q4FY24 results. There was a question around CET1 accretion. I'd just like to flag off that the guideline has multiple balancing factors. While appreciation goes into AFS reserve, some of the risk weights on classes of investments also move up. So it'll be a function of specific portfolio positions as at reporting date. Therefore, we would not like to comment on it as at today.
Sure. Thank you very much. And all the best.
Thank you very much. Ladies and gentlemen, we'll take the last question from the line of Sameer Bhise from JM Financial. Please go ahead.
Yeah, hi. Congrats on a good set of numbers. So I think good job on reducing the RIDF concentration in the overall pie. Can you elaborate on how the bank is positioned on PSL with respect to some of the subsegments?
Thank you for the question. For FY24, the bank's own assessment is that it is compliant on PSL at the headline level and at each subsegment level.
Okay. And most of that has been primarily organic or I mean, in terms of PSLC acquisition, some details would be helpful.
It's a mix of organic and PSLC. Our organic performance has improved year on year. But yes, we do incur a PSLC cost, which is reflected in our cost to assets ratio. It's a combination of both that has got us to the achievement, with organic now contributing more than it did in the last financial year.
Okay, that's helpful. Finally, could you share the gross slippage number across wholesale and retail segments?
Our gross slippage number for the quarter is 3,471 crores. It declined 7% on a quarter-on-quarter basis. 3,110 crores is retail, 163 crores is our CBG business, and 198 crores is our WBCG business, which is wholesale.
Okay, this is helpful. Thank you and all the best. Thanks a lot.
Thank you.
Thank you very much. I'll now hand the conference over to Mr. Puneet Sharma for closing comments.
Thank you, Nirav. Thank you, everyone, for taking the time to spend the evening with us. I hope we've been able to address all of your questions today. If any questions remain unaddressed, please do reach out to Abhijit and the IR team. We'd be very happy to take questions on a one-on-one basis and offer further clarifications. Good evening and have a good day.
Thank you very much. On behalf of Axis Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.